What if I told you some of the smartest investors in America are quietly moving money out of entire states? Not because of politics, not because of taxes, but because of water. That sounds dramatic, but it's already happening. For decades, real estate investors chased the same formula. Buy in coastal markets, hold in fast-growing suburbs, rent in popular vacation zones. It worked. But now there's a new factor changing everything: climate risk. Flooding, rising insurance costs, rebuilding expenses, and migration trends are rewriting the map. And while many people are still focused on yesterday's hot markets, experienced investors are already looking toward tomorrow's safer ones. One city keeps showing up in those conversations: Phoenix. Now, before you say, "Phoenix, isn't that the desert?" stay with me, because what's happening there tells a much bigger story about where wealth may move next. Let's start with the markets losing momentum. Across parts of Florida, Louisiana, coastal Texas, and some areas of the Carolinas, investors are facing a new reality. Properties that once looked like guaranteed winners are becoming harder to model. Why? Because insurance costs are exploding. In some flood-prone areas, owners have seen premiums double or even triple over a few years. Some carriers have pulled out entirely. That means fewer options, higher costs, and more uncertainty. And uncertainty is poison for serious investors. Imagine owning a rental property that cash flowed nicely 2 years ago. Then insurance jumps by $4,000 a year. Maintenance costs rise after repeated storms. Tenants hesitate because they've experienced flooding twice in 3 years. Suddenly, the numbers that once looked amazing start to crack. This is why many experienced investors aren't panicking publicly, but they are reallocating quietly. They're asking one question: where can we place capital that has population growth, job growth, housing demand, and lower exposure to recurring flood disasters? That's where Phoenix enters the conversation. Phoenix has been growing for years, but now it's attracting attention for a different reason. It offers something increasingly valuable in modern investing: relative predictability. Compared with many coastal flood zones, Phoenix avoids hurricanes, storm surge, and repeated large-scale flood damage. That matters more than ever. But safety alone doesn't create opportunity. What makes Phoenix interesting is the combination of migration and economics. People from California, Washington, Illinois, New York, and even parts of Florida have been relocating for affordability, lifestyle, and business opportunities. When people move, demand follows. Demand creates rent pressure, home purchases, retail growth, and infrastructure expansion. And smart investors follow demand. Think about it this way: real estate isn't really about buildings. It's about people. Where they move, where they work, where they spend, where they raise families. Phoenix has become one of those magnets. Major employers have expanded in Arizona. Warehousing, logistics, healthcare, tech manufacturing, and service industries have all added momentum. Every new job can create housing demand, not just for buyers, but renters too. That's what investors notice. They're not buying because Phoenix is trendy. They're buying because migration creates a chain reaction. More residents mean more apartments needed. More families mean more suburban homes needed. More workers mean more retail centers, restaurants, storage units, and local services needed. That's how entire markets grow. Meanwhile, some flood-heavy regions are dealing with the opposite problem: friction. Even if a city is desirable, repeated weather disruptions slow confidence. Buyers ask harder questions. Lenders become more cautious. Insurance becomes more expensive. Repair timelines stretch longer. None of this means flood states are finished. Far from it. Florida still has strong migration. Texas still has major economic powerhouses. Coastal areas will always attract buyers. But smart investors don't think in headlines. They think in margins. If two markets both grow at similar rates, but one has rising insurance chaos and higher disaster exposure, while the other has cleaner numbers and strong demand, where do you think institutional money leans? Exactly. And here's where most everyday investors miss the shift. They look at home prices only. Professionals look at net yield after taxes, insurance, maintenance, vacancy risk, and long-term resilience. That difference changes everything, because a cheaper property in a risky zone can become more expensive than a higher-priced property in a stable market. Phoenix isn't winning because it's perfect. It's winning because in a changing environment, good enough and predictable can beat beautiful but volatile. And there's another reason this story matters. Once migration patterns begin, they often build momentum. People move where friends moved. Companies expand where talent moved. Builders construct where demand moved. That creates a feedback loop investors love. The question now is whether Phoenix is just one city benefiting, or the early example of a much larger national shift. Because this isn't only about Phoenix, it's about a new era where climate risk is becoming an investment metric. For years, investors focused on the usual checklist: locations, schools, taxes, jobs, crime rates, rental demand. Those still matter. But now another line has been added to the spreadsheet. How expensive will this property be to protect over the next 10 years? That question alone is changing decisions across America. A beachfront rental may still look attractive on Instagram. A waterfront condo may still sell quickly in the right season. But sophisticated buyers are running deeper numbers now. What happens if insurance rises another 40%? What happens if storms damage the property twice in 5 years? What happens if tenants leave after repeated disruptions? What happens if lenders tighten requirements? That's how serious money thinks. And when they compare those risks to inland growth markets like Phoenix, the math often becomes clearer. Phoenix offers something many investors now value more than excitement: operational simplicity. No hurricane prep every season. No storm surge fears. No annual stress watching weather maps during peak season. No guessing whether the next insurance renewal will wreck cash flow. That stability has real financial value. Now, to be fair, Phoenix has its own challenges. Every market does. Heat is a real issue. Water supply is debated constantly. Affordability has tightened compared with years past. Competition can be stronger than many realize. But smart investors understand an important truth. Every market has risks. The goal is not zero risk. The goal is manageable risk. That's why Phoenix remains attractive. Its challenges are visible, measurable, and often easier to model than unpredictable flooding losses. And when investors can model risk, they can price it. That's where opportunity lives. Let's talk population shifts, because this may be the biggest signal of all. When families leave expensive or disaster-fatigued regions, they don't disappear. They relocate. They bring income, spending habits, and housing demand with them. One household moving may seem small. 10,000 households moving changes a metro area. That means stronger rental occupancy, more demand for starter homes, more traffic for local businesses, higher need for schools, healthcare, and services. That's why migration trends can create years of ripple effects. And Phoenix has benefited from exactly that pattern. Many people moving there are not starting from zero. They're arriving with remote jobs, equity from homes sold elsewhere, retirement savings, or business income. That can support stronger home prices and consumer spending. Investors pay close attention to that kind of incoming resident, because not all population growth is equal. Now here's the twist most people ignore. By the time the average person notices a trend, early investors are already positioned. When headlines say, "Everyone is moving to Phoenix," some of the best opportunities may already be shrinking. That doesn't mean the story is over. It means timing matters. The smarter lesson isn't buy Phoenix no matter what. The smarter lesson is to understand why capital moved there in the first place. It moved toward demand. It moved toward relative stability. It moved away from rising hidden costs. That same logic can reveal tomorrow's opportunities in other inland growth markets too. Maybe it's parts of Arizona, maybe Nevada, maybe Tennessee, maybe select cities in the Carolinas, away from major flood exposure. Maybe entirely different markets most people aren't watching yet. Because smart investing is rarely about chasing what is famous. It's about spotting what is becoming valuable before everyone agrees. So if you're thinking like an investor in 2026 and beyond, ask different questions. Where are people moving? Where are businesses hiring? Where are insurance costs becoming painful? Where are long-term ownership costs still reasonable? Where can you hold assets without constant disruption? Those questions matter more now than they did 10 years ago. And that's why some of the smartest investors are quietly leaving flood states, not out of fear, but out of strategy. They're not reacting to one storm. They're reacting to a decade of changing economics. Phoenix just happens to be one of the clearest examples. The map of opportunity is shifting, slowly for some people, rapidly for others. And the investors who understand that shift early may build the next wave of wealth, while everyone else is still arguing about the last one. If you enjoyed this breakdown and want more future-focused investing trends, smart money moves, and hidden wealth shifts happening right now, subscribe and stay with the channel. The next big opportunity usually looks boring before it looks obvious.